Welcome back to the deep dive. Today we were taking a monumental trip through the economic theory that dictates perhaps the most fundamental decision you make every single day.
And that is, how much do you consume right now, and how much do you save for the distant and, pretty uncertain future?
Exactly. We are diving deep into the foundations of modern consumption theory, and we're using Angus Deaton's seminal 1993 work, Understanding Consumption, as our guide.
This is such a crucial area of study because really it's where economics met reality head on. For decades, the field was dominated by these extraordinarily elegant, fully unified theoretical models.
You're talking about the life cycle hypothesis and the permanent income hypothesis.
That's right, the LCH and the PIH. And these models, they depicted every person as this hyper-rational, long-lived supercomputer, perfectly optimizing their choices across their entire lifetime.
They sound beautiful in a textbook, almost too perfect.
They are. But by the early 1990s, the real-world data, the actual spending habits of real households, had delivered a series of sharp, systematic punches to those clean models.
So Deaton's book really captures this moment of crisis then.
It does. It's the moment economists were forced to concede that the cornerstone of macroeconomics, the representative agent, this fictional, single, optimal decision-maker, was profoundly failing to describe what was happening in the aggregate.
Okay, so let's unpack this enormous shift. We have a compelling story here about, disillusionment. And then this urgent scientific need to rebuild the whole framework of consumption.
That's the mission today, to follow that path.
So first, we need to really internalize the logic of those initial, almost flawless theories of intertemporal choice.
And then we have to confront the dramatic, systematic empirical failures, the famous consumption puzzles that just kept popping up in the aggregate data.
Things like excess sensitivity and the failure of hump saving.
Exactly. And finally, we'll explore the more complicated, yet much more human alternatives that economists develop to try and fix those failures.
These would be the models that introduce concepts like precautionary saving and liquidity constraints.
Yes. And they turn out to have massive explanatory power for why real people behave the way they do. Deaton's work effectively synthesizes 15 years of intense research that all kicked off after Robert Hall's 1978 paper.
The one that applied rational expectations to this field.
Right. And our goal here isn't just reading charts. It's about gaining the intuition behind why, despite all these incredible theoretical advances, so many substantive questions about saving and spending are still elusive.
It's the story of how much has been learned through humility. Let's get into it. Okay, let's start at the very beginning. The theoretical engine that powers this entire field, intertemporal choice. If you simplify all of human economic life down to one single maximization problem, what is the core decision that every consumer is supposedly solving?
Well, the canonical problem is, on the surface, pretty straightforward. You are maximizing your total lifetime utility.
My total happiness, basically.
Your total happiness, subject to a single overarching lifetime budget constraint. You're just deciding how to spread your enjoyment, your consumption, across your entire lifespan, from birth to death.
And the rule is you can't spend more than you have over that entire lifetime.
That's the constraint. And your total lifetime resources is a really key concept here.
Okay, so what goes into that definition? It's not just the money in my bank account today, right?
Not at all. It's the sum of two major components. First, yes, your current financial assets, when you have in the bank, are invested right now.
Simple enough.
But second, and this is much more complex, is the present discounted value of all your expected future labor incomes.
So all the paychecks I haven't earned yet.
Exactly. Economists call this latter intangible piece your human capital. And the central mechanism that connects all of this, the past, present, and future, is the discount factor.
Which is 1 plus r to the minus 1.
Precisely. The discount factor is essentially the weight we assign to future dollars versus current dollars. The real interest rate, R, acts as the price of future consumption relative to current consumption.
So if R is high, future consumption is cheap.
It's cheap because every dollar you save today buys you more tomorrow. This seems simple, but this is actually where a lot of the layperson intuition gets stuck.
Right. We tend to think high interest rate, save more, consume less, Seems obvious.
It does seem obvious, but the sources make it crystal clear that the role of interest rates is actually incredibly ambiguous
Why is that?
because it unleashes multiple economic forces at the same time. An increase in the interest rate doesn't just trigger one effect, it triggers three competing forces simultaneously, and they often push your current consumption in totally different directions.
Okay, this is important. Let's break those three down one by one. How do they each impact my spending today?
So the first is the substitution effect. This is the intuitive one. Future consumption is now relatively cheaper because saving gives you a higher return.
So I substitute today's spending for tomorrow's.
Exactly. You're incentivized to substitute away from current consumption and into future consumption by saving more. The substitution effect is always negative on what you spend today.
Okay, so if the bank offers 10%, I might skip buying a new TV today for a much better retirement portfolio tomorrow.
That's it, precisely. Now, working against that is the income effect.
The income effect.
A higher interest rate means that your existing assets and any saving you do earn more money. If you're a net saver, this effectively increases your total lifetime resources. You're made wealthier by the rate change.
And richer people spend more.
So the income effect works to increase current consumption. It has a positive effect. Think of a retiree living off their portfolio. An increase in R makes them unequivocally richer, and they'll probably consume more today.
So already we have the substitution effect fighting the income effect. What's the final and maybe the most subtle force?
That would be the human capital effect. This one primarily affects the working age population.
The people whose wealth is mostly in future earnings.
Exactly. As we said, a huge part of your resources is the present discounted value of all those future wages. When the interest rate rises, you have to discount those future earnings much more heavily.
Ah, so my future salary is suddenly worth less in today's dollars.
Right. For a young worker whose income is mostly in the future, a rise in R actually reduces the present valuation of their human capital.
So they feel poorer even though their paycheck hasn't actually changed?
That's the psychology of it, yes. This reduction in the perceived present value of their total lifetime resources makes them feel poorer, and that prompts them to cut back on current consumption.
So the human capital effect is another negative force on my spending today.
It is. So you have this phenomenal piece of economic jujitsu. Two negative forces, substitution and human capital, and one positive force, the income effect, all vying for dominance.
And the key insight from the theory is what then?
That because of this three-way tug of war, the net direction of how interest rates affect the level of consumption, well, it's fundamentally unpredictable just from theory alone.
So we can't just state, as a universal rule, higher interest rates mean people save more.
You can't. The outcome depends entirely on an individual's mix of current assets, their future income expectations, and, their basic level of patience.
This complexity, right at the outset, it really shows just how fragile these elegant models might be when you're dealing with a population of diverse individuals.
Absolutely. Now, let's just for a moment ignore uncertainty. Let's assume we live in a world of perfect foresight, constant needs. The life cycle hypothesis gives us very clear predictions about what our consumption profile should look like over a lifetime.
And in this simple, certain world, how does my consumption evolve with age? Does it track my income?
It absolutely does not track your income. If you can borrow and lend freely, anticipated changes in your income are, for the most part, irrelevant.
So what governs the shape of my spending profile then?
Only two factors, the real interest rate and your rate of time preference, which we call delta.
Delta is my level of impatience, right?
It's your impatience. The theory says consumption will be growing with age if the incentive to wait, that's R, is greater than your impatience, delta.
So the market is rewarding my patience more than I naturally value immediate satisfaction?
That's a perfect way to put it. If R is greater than delta, it pays to postpone consumption, so your consumption profile slopes upward over your life.
And if I'm very impatient?
If you're very impatient, delta is greater than R. You want your consumption concentrated early in life, and so your profile slopes downward. The central message of the LCH is all about smoothing. You spread your resources out to avoid painful dips or unnecessary peaks in spending, regardless of when you happen to earn your wages.
The source material also brings up this issue of intertemporal consistency. This sounds a bit like a behavioral problem dressed up in economic language.
It's what's called dynamic consistency. For this entire rational planning framework to hold up, the plan you make today for what you'll spend next year, well, it has to be the plan you still want to execute when next year actually arrives.
Unless new information comes along.
Right. If you suddenly want to change your pre-made plan, even though no new information, no uncertainty, no change in your basic preferences has occurred, then you are being dynamically inconsistent.
It's the difference between planning to start a healthy diet next week and then on Monday morning deciding that plan really needs to be revised to include donuts.
That's a perfect analogy. And economists found that certain kinds of utility functions, especially those that depend only on the distance between now and the future, they often lead to this kind of inconsistent planning. The rational agent has to be consistent.
Okay, moving beyond just the timing, we have to talk about preference structure. The simplest model, intertemporally additive utility, it assumes that the happiness I get from a meal today is totally independent of the meal I had yesterday.
And that's the standard, very convenient assumption. Total utility is just the simple sum of utility from consumption in each period. But we know this is often false in reality.
Because consumption effects persist.
Exactly. That's why we introduce what's called temporal dependence.
And what are the two major ways my spending today can affect my happiness tomorrow?
The first is habits. If my consumption today raises the standard for my satisfaction tomorrow, say I start driving luxury cars, then that previous consumption actually detracts from the utility I get from future consumption. The bar is now higher.
That sounds like a perpetual treadmill of dissatisfaction.
It can be. The other side of that coin is durables.
Things like a car or a fridge.
Right. If I buy a durable good, the utility I get from that purchase persists. Consumption in period TAT actually adds to my utility in TAT +1 because the good hasn't worn off.
So in theory, these canonical models, the LCH and the PIH, they're beautifully structured. They fully describe how a rational person should manage their entire life savings under certainty.
They're magnificent constructs. But the moment we introduce two things, uncertainty, which complicates the math, and messy real-world data, which provides empirical rejection, the model starts to unravel very, very quickly.
And that transition from mathematical elegance to empirical reality, that's the story of the great consumption puzzles. Okay, let's start with the life cycle hypothesis and saving. The original theory offered this really powerful explanation for why countries grow. This stripped-down LCH prediction was that aggregate positive saving would occur just naturally in a growing economy.
Yes, because the young, productive saving generation would simply outweigh the older, retired, dis-saving generation. They call this hump saving.
The theory predicted that aggregate saving would be generated purely by productivity growth or population growth.
Right. This became a really powerful, stylized fact in macroeconomics. And initially, the macro data seemed to support it robustly.
You mean the cross-country data, right? Looking at different nations?
Yes. The empirical evidence repeatedly showed a positive, strong relationship between national saving rates and national growth rates across a whole range of diverse countries. Deaton even notes that the cross-country regression slope between saving and growth rates, about 1.34, is remarkably close to the quantitative prediction of the simplest LCH model.
So at the aggregate national level, the LCH looks like a total triumph.
It looks like a triumph, but here's the catch. The theory relies entirely on the assumption of hump saving happening at the micro level.
Meaning that individuals are diligently saving during their middle highest earning years.
And then vigorously drawing down their wealth to saving in retirement.
And what did the micro data, the data on actual families, reveal?
The micro data systematically failed to find this hump. This is the micro problem. The consumption profiles observed for individuals in the U.S., in Taiwan, the Ivory Coast. They often showed consumption closely tracking income profiles over the life cycle.
Wait, so that means there was very little net hump saving actually occurring?
Very little. If you earned your money late in life, you spent it late. If you earned it early, you spent it early. People weren't smoothing the way the model said they should be.
But wait, if people aren't saving much during middle age, where's all the wealth coming from to fund the aggregate saving rate? And why are the elderly still holding on to their assets?
That is exactly the puzzle. And it just got deeper when economists looked specifically at the behavior of the elderly.
What did they find?
Studies by people like Myrer and Danziger found that the elderly typically save very little. Instead of drawing down their wealth aggressively, as the theory requires, they often keep their assets steady right up until death.
That just fundamentally challenges the LCH prediction of wealth decumulation.
It really does. If the elderly aren't spending the wealth they supposedly saved, the LCH cannot be the primary driver of national saving.
So it must be pointing towards alternative motives.
Strongly. Specifically things like bequests, leaving money to children, or maybe precautionary saving against massive unexpected costs like a catastrophic health event late in life.
Okay, so the failure of the elderly to save is maybe the most famous and durable piece of evidence against the simple LCH.
It's a huge one.
Let's move to the permanent income hypothesis, the PIH. The key theoretical insight here, following Hall's work, was that consumption should follow a random walk. Can you explain what that means intuitively?
So the random walk is the outcome of optimization under rational expectations. If you are rational, you use all available information to forecast your future income.
So I'm always looking ahead.
Always. Therefore, you should adjust your consumption immediately when you receive any new information about your lifetime wealth. Since you're constantly optimizing, your consumption today already incorporates everything you knew yesterday.
So the change in my consumption from yesterday to today should be driven only by new information and innovation that was fundamentally unpredictable.
That's it. Lagged income or any variable you already knew about last period should have absolutely no predictive power over how much you change your consumption today.
So if I know I'm getting a big bonus in 6 months, I should start spending some of that today, maybe by borrowing, to smooth out my consumption profile.
That's the rational thing to do, according to the model. But how did the empirical tests of this prediction fare?
Well, I'm guessing.
They failed decisively. This failure is labeled excess sensitivity. Researchers, most famously Flavin and then later Campbell and Mankey, showed robustly that changes in consumption are predictable by lagged changes in income.
So people wait.
Consumers appear to wait for the predictable income change to actually arrive in their bank account before they adjust their spending.
And how large was this violation of the theory?
For aggregate consumption of non-durables and services, the data showed that consumption changes by perhaps 30 to 40% of the predictable change in income.
And if the PIH were true, that percentage should be zero.
It should be zero. The fact that aggregate data shows this delayed fractional response to income changes that were clearly anticipated, well, it violates the core principle of rational consumption smoothing.
It's as if a third of the population is behaving in a purely Keynesian way. They just spend when the paycheck arrives, regardless of what they knew beforehand.
That's a great way to think about it. It's a huge chunk of the economy violating the rational expectations model. And this is the defining rejection of the rational PIH at the macro level.
And the problems didn't stop there, did they?
Not at all. Next, we get into the volatility debate. Is consumption too smooth or is it too volatile? And this depends entirely on what you assume about the nature of income shocks.
This involves that technical distinction between two views of how income behaves statistically. Let's try to make that clear for everyone listening.
This is crucial. Economists have to choose between two different models for income processes. The first is the trend stationary model.
Okay, what's that?
Think of this as an income tied to a deterministic trend, like a standard salary that increases predictably with age. If you get a temporary shock, like a bad month, you expect your income to revert back to its established trend line eventually.
So innovations are temporary and small. If a professor gets an unexpected grant bonus this year, they know it won't repeat.
Exactly. And because that shock is temporary, it adds very little to your lifetime permanent income. Therefore, under the PIH, you are justified in making only a small change in consumption. Consumption remains much smoother than income.
Okay, that makes sense. What's the second, more problematic view?
The different stationary model. It's often described as having a unit route or following a random walk with a drift. In this view, any innovation is permanent.
So if my income unexpectedly rises, that new higher level becomes the new baseline forever.
That's the idea. Income doesn't revert to a past trend. The trend itself is shifted permanently upward.
If that's true, and a lot of macroeconomic data suggests it is, then an unexpected raise is worth far more to me. It's not just a raise for this year, it's a raise for the rest of my life.
Exactly. And this leads to what's called the paradox of persistence. Simple calculations using these different stationary models show that an innovation in your current income can cause your permanent lifetime income to change by more than 1-for-1 with the innovation.
Whoa, hold on. If my expected lifetime income changes by 110% of my current unexpected pay raise, then my current consumption should change more than the change in my current income did.
That is the bizarre theoretical implication. If income is different stationary, the observed smoothness of consumption becomes a new puzzle. Excess smoothness.
So the PIH, which was designed to explain why consumption is smoother than income, suddenly predicts the opposite, that consumption should be more volatile than measured income.
And the simple observation that consumption is smooth stands in direct contradiction to these preferred time series models of income.
It seems like the PIH is damned if income is temporary because we get excess sensitivity, and it's damned if income is permanent because we get excess smoothness. It's a no-win scenario.
It highlights a massive vulnerability. The models require economists to accurately characterize the consumer's expectations about the permanence of shocks, which is information we simply do not possess.
And this brings us back to the role of superior information, the knowledge gap.
The consumer knows more than the econometrician.
Always.
Consumers possess all this superior private information about their future, their job security, their health, their business prospects, that we can't model using just lagged public data. A farmer knows his crops are failing long before the official GDP statistics reflect an agricultural shock.
So what looks to the econometrician like a small, smooth consumption response to a big aggregate shock might actually be a perfectly appropriate large response to the small, unanticipated part of the shock that the consumer didn't already know about.
That's the interpretation. And it's a very humbling conclusion for the rational PIH.
The recurring theme here, underlying all these macro puzzles, is that the representative agent model is just fundamentally flawed. This is the model that treats aggregate consumption as if it were generated by one single optimizing super individual.
The RA is a beautiful, simplifying mathematical fiction, but Deaton is very clear on its failings. This mythical agent has two deep structural problems. He says they know too much and they live too long.
Okay, let's start with the RA knowing too much, especially when it comes to risk. This leads to the famous equity premium puzzle.
It's one of the biggest paradoxes in modern finance. The RA model assumes this single agent's standard of living is tied to aggregate consumption, which, on the whole, is remarkably smooth. It's not very volatile.
So if your living standard isn't at great risk, you shouldn't demand a huge premium to hold risky assets like stocks over safe assets like treasury bills.
You shouldn't. But the real-world historical data tells a completely different story.
It does.
Historically, the expected yield difference, the equity premium, has been massive, around 6% in real terms.
So to make the RA model fit that fact, what do you have to assume about the agent?
You have to assume the agent is absurdly risk-averse.
And how absurd are we talking here?
We're talking about risk aversion parameters of few for greater than 20. To put that into perspective, an agent with a roll of 20 would refuse a 50-50 chance of either winning $1 million or losing just $100.
Wow.
They are so terrified of the smallest possible negative outcome that they will forego enormous potential wealth gains. That kind of parameter choice is, behaviorally preposterous.
It signals the model just isn't describing actual market behavior.
Not at all. And the RA is also flawed because it lived too long, which leads to the negative time preference puzzle.
Okay, what's that?
If we look at long-term aggregate data, consumption growth has been positive. The average person consumes more each year. Yet average real interest rates have frequently been negative or near zero.
So to reconcile positive consumption growth with negative interest rates using the RA's optimization equation, what does that imply about its patience?
It implies the RA has a negative rate of time preference, a negative delta. This means the agent actively prefers consuming in the future over consuming today, even when current consumption is cheaper.
They're too patient.
Way too patient.
Yeah.
Preferring future utility even when it costs more is, as Deaton says, far from standard interpretation. These puzzles collectively show that aggregate behavior just doesn't conform to the optimization of a single, infinitely lived agent.
So the problem isn't necessarily that individuals are irrational, but that we can't just scale up individual rationality to the macro level. This is the issue of genuine aggregation failure.
Absolutely. And the work by Clarendon and Galli is particularly illuminating here. They showed that in an economy with finitely lived consumers, real people who are born and die aggregate behavior necessarily deviates from individual behavior.
Even when every single person is perfectly optimizing.
Even then, the very mechanics of births and deaths inherently generate distortions.
How do they complicate the perfect smoothing idea?
Well, new cohorts being born are typically richer and more productive than the old cohorts who are dying, just because of overall economic growth. This demographic churn alone drives aggregate consumption upward.
So when an economy-wide shock hits,
the response is lagged and fractional because that shock is diffused across all these different generations, and each generation has different consumption rules, different wealth levels, and different remaining life expectancies.
So the aggregate consumption number we see is just this messy blend of all these different groups. No wonder a single model struggles to capture it.
And another crucial aggregation failure comes from imperfect information. a concept explored by Pischke. The RA model assumes every individual immediately processes all aggregate information,
But real people don't read macroeconomic forecasts every day. Why is that rational?
because the value of that knowledge is trivially small to the individual. Pischke estimated that the resulting increase in welfare from acquiring and processing all that complex macro data, the utility gain from better lifetime planning, is less than 50 cents per quarter for the average consumer.
Less than 50 cents worth of utility gain every 3 months? That's remarkable.
It makes rational ignorance a virtue. If the value of acquiring that information is so low, individuals will rationally ignore it.
And what's the consequence of that?
The crucial consequence is that consumers can't perfectly separate small individual transitory shocks, like a broken toaster, from large persistent aggregate shocks, like a recession.
And if they can't separate them, how do they react?
They only respond sluggishly to the aggregate income news. They treat persistent aggregate shocks as if they were temporary and isolated. The aggregate consumption change, when you measure it, therefore appears strongly autoregressive.
Meaning today's change is highly correlated with yesterday's change.
Yes, and here is where it gets really interesting. That sluggish, autoregressive behavior in the aggregate data, it looks exactly like habit formation.
So the macro outcome, sluggish adjustment, can look like a fundamental behavioral thing like habits that doesn't even exist at the micro level.
Exactly. The average individual might be entirely rational and have no habits, but because they're rationally ignorant of macro data, the resulting statistical aggregate appears to have these persistent habits.
That is the perfect summary of the micro-macro disconnect.
It is. The simple aggregation of these fundamentally different income experiences means the aggregate data is, in a way, lying to us about what individuals are doing.
And just to close the loop, the attempt to save the representative agent by appealing to these infinite families, this idea of intergenerational altruism.
That was conclusively rejected.
Conclusively negative. Empirical tests using parent-child data showed a strong rejection of both complete markets and intergenerational altruism. The RA model, in its infinite life form, just has no basis in the micro-level behavior of actual families.
So it's evident that the rational, frictionless, simple models just failed. The response by economists was then to embrace reality. Real people face uncertainty, and real people cannot always borrow.
Which brings us to the precautionary saving motive.
Right. When uncertainty is brought into the model, the assumption of certainty equivalence, which meant marginal utility was linear and wiped out any reason to save for a rainy day, that has to be abandoned.
We have to acknowledge that individuals save to protect themselves against bad luck.
And how does the theory formally incorporate this fear of bad luck?
It's through the concept of prudence. The precautionary motive arises if the marginal utility of consumption is convex. Okay, what does that mean intuitively?
Intuitively, it means the pain of losing $1 when you are poor is exponentially greater than the pleasure of gaining $1 when you are rich. The marginal value of consumption is much, much higher when consumption is low, when you're just scraping by.
So convexity captures the fear of hitting the bottom.
Exactly. And when the uncertainty of your future consumption increases, when the risk of hitting the bottom goes up, this prompts a reduction in your current consumption and a voluntary increase in saving. It acts as self-insurance.
You save more today because you are terrified of the marginal impact of a negative shock tomorrow.
That's the motive. And this voluntary saving for a rainy day has profound consequences, especially for that life cycle hypothesis failure we talked about, which Carroll explored in his work on the buffer stock model.
How so?
It provides a powerful explanation for why consumption and income rise together in early life, which solves one of the core puzzles. Young people often don't borrow as much as the standard LCH would suggest, nor do they immediately spend their expected future raises.
They save instead.
They save, not because they are forced to, but because they are prudently protecting themselves against potential job loss or some other bad shock. This precautionary behavior allows consumption to track income more closely over the life cycle, even among perfectly optimizing agents.
Okay, so that adds a layer of fear. Now let's layer on the second major imperfection, the liquidity constraint.
This is the non-negativity constraint on assets, the formal inability to borrow. This isn't a matter of choice. It's a lack of access to credit.
And if I cannot borrow when times are bad, that inability dramatically strengthens my need to save when times are good?
Absolutely. The liquidity constraint dramatically strengthens the precautionary motive because the primary source of external insurance, the ability to borrow against future income, is completely closed off. You must self-insure.
The buffer stock model, developed by Deaton and LaRocque, addresses this head-on. What does it suggest about the behavior of even impatient, constrained consumers?
It shows that even highly impatient consumers, those whose time preference is greater than the real interest rate, who would theoretically want to borrow heavily, will generally want to hold assets as a buffer stock
Why?
to guard against future income fluctuations simply because they can't access credit markets. They're saving just to maintain flexibility.
And this model generates results that actually match the stylized facts we observe in the real world.
Yes. Simulated behavior shows that this buffer stock approach generates consumption that is significantly smoother than income. In some simulations, the standard deviation of consumption was less than half that of income.
Wow.
And moreover, it's entirely consistent with the stylized fact that median household liquid assets in the U.S. are very modest, often less than $1,000.
$1,000 seems like nothing, but you're saying that even that small a buffer is incredibly effective.
It is. These small amounts are capable of making consumption substantially smoother than income by acting as a short-term buffer against routine monthly shocks in short periods of unemployment.
I find the insight about the asymmetry of consumption under these constraints particularly powerful. It suggests that good news and bad news affect us very differently.
That's a key insight of the constrained model. If you get a large positive income shock, you can't really spend much more today without violating your optimal smoothing plan, so you save most of it. You cut off potential upward spikes in consumption.
But on the downside,
However, if you get a large negative income shock and your buffer of assets is already exhausted, the borrowing constraint prevents you from smoothing.
you can't borrow your way out of trouble.
Correct. The constraint forces your consumption to drop down severely. So this inability to borrow creates an asymmetry. Consumption is smoothed against upward shocks by saving, but it can't be perfectly smoothed against downward shocks once the buffer is gone.
Which leads to those sharp downward consumption spikes for the household.
Exactly. This is messy, but it's deeply explanatory of how real households operate.
And the book highlights a critical overlap between these two models of imperfection, right?
This is the convergence, the unresolved debate. The liquidity constraints model, where impatience forces you to buffer because credit markets are closed, and the precautionary saving model, where voluntary prudence drives buffering because of risk aversion. They generate essentially identical buffering behavior.
So it's incredibly difficult to separate the two empirically just by looking at the data.
Very, very difficult.
Yep.
Yet both approaches lead us far away from that high-flying LCH-PIH structure.
How so?
They both diverge sharply by exhibiting a strong Keynesian flavor. Instead of basing consumption on the annuity value of your total lifetime resources, that LCH focus on the very distant future, both prudence and liquidity constraints mean that current consumption responds directly and significantly to current income.
And to near-term prospects.
The effective planning horizon just shortens drastically, often to only a few years, which is basically the period until your buffer might run out.
So whether you're driven by fear, which is prudence, or by market failure, which is liquidity constraints, the end result is that your spending tracks your current cash flow much more closely.
And that provides a powerful explanation for the excess sensitivity puzzle that baffled the original PIH economists.
This has been a truly detailed exploration of how consumption theory has evolved. We started with the elegance of the life cycle and permanent income hypotheses, and then watched them just shatter against these empirical realities.
Realities like excess sensitivity and the strange persistence of wealth among the elderly.
Right. And we have certainly achieved massive methodological progress.
No doubt. The field unified LCH and PIH into a general, formidable theory of intertemporal choice. We learned how to formally treat uncertainty and employ rational expectations. We know consumption isn't a random walk, and we have powerful alternatives like the buffer stock model.
But despite those methodological triumphs, the critique from the 1990s seems to remain valid today. What are the most enduring, unresolved, substantive puzzles that keep economists working late into the night?
Well, three major puzzles from the book still resist easy answers. First, what determines the vast cross-country variation in national saving ratios?
If it's not just the simple life cycle demographics, which the microdata fail to confirm,
Then the underlying behavioral or institutional factors remain elusive. Second, there's the near-universal phenomenon of declining saving rates across developed countries over the last few decades. Simple growth models just fail to capture this synchronized drop.
And the third puzzle brings us right back to the end of life.
Yes, the lack of elderly to saving is perhaps the most fundamental challenge. If people are not spending down their wealth, It strongly suggests that bequests, or maybe this immense precautionary motive against unforeseen catastrophic medical costs, are far more important drivers of wealth accumulation than simple retirement smoothing.
That lack of saving really challenges our understanding of what wealth is for in a developed economy.
It absolutely does.
So if the representative agent is a myth, as we've established, what does the path forward look like for consumption research?
The book argues very strongly that we must stop trying to resuscitate this mythical representative agent. The path forward lies in a serious engagement with aggregation issues.
Moving toward using partially aggregated data.
Specifically cohort data, where we track the averages of specific age groups, say, people born between 1950 and 1960 over time.
And tracking cohorts lets us see how demographics and lifetime experiences interact without confusing micro-level behavior with these macro-level statistical artifacts.
Exactly. This allows us to reconcile the dynamics we see in individual households, like the success of a tiny buffer stock, with the dynamics we see in the aggregate economy. The joy of discovery now lies in that granular data.
So the final provocative thought we want to leave you with builds on that powerful insight from the buffer stock model. If the average U.S. household holds less than $1,000 in liquid assets, but those small savings are demonstrably enough to smooth consumption substantially against temporary shocks, what does that tell us about the real fragility of the economy?
It's a critical question.
If that small, fragile firewall is all that stands between smooth consumption and downward spikes for the majority of households, what happens when they face a severe, widespread, shared shock that lasts longer than that small buffer can withstand?
That is the modern consumption challenge.
Thank you for joining us for the deep dive.